Accountants record adjusting journal entries during the month close process to ensure that the financial results comply with generally accepted accounting principles, such as the matching principle, revenue recognition standards, and the accrual method of accounting. Why is that important? Financial statements are basis for making decisions for both internal and external users. And accountants have the important responsibility to protect the public trust in the accounting profession. Adjusting entries are typically categorized as deferrals and accruals. Deferrals include costs that are recorded as assets until they are used up. At that time, they are moved to an expense account. Prepaid expenses are a good example of a deferred cost. Deferrals also include revenues for which the revenue recognition process has not been yet completed. When the revenue recognition process is complete, these liabilities are moved from the balance sheet to the income statement and recorded as revenue. Accruals of expenses are recorded as liabilities when the expense was incurred by the company and can be estimated. This ensures that the company recognizes expenses according to the matching principle. Accruals of revenue are recorded as a receivable when revenue has been earned, has not yet been invoiced to the customer but can be estimated. How do accountants figure all this out? First, accountants review balance sheet accounts and the related reconciliations, as well as an income statement accounts to assess what accounts require adjustments and then record the adjustments in a journal entry. In addition, the accountant reviews income statement trend reports to identify unusual trends that might indicate missing expenses. For instance, the accountant looks at an income statement trend report and notices that consulting services have been between $9,000 to $10,000 every month, but in the current month, consulting costs have only been recorded for $2,000. The accountant reviews the account activity and finds that one consultant has not submitted the consulting invoice for the month. And, based on that information and after further research, the accountant records an accrual for the estimated consulting expenses. Another example is when the company has invoiced a customer for $50,000 training but the services have not yet been completely performed. The accountant determines the amount of training services that must still be completed and records that amount to a contra revenue account and a balance sheet liability. In addition, the accounting department is in regular contact with other business leaders to understand if new contracts were signed or discontinued or if the company has determined a new risk, for example, a lawsuit, that needs to be evaluated. Accountants spend a significant amount of time on determining and recording these adjustments. Documenting assumptions and ensuring proper supporting information is very important. Adjusting entries for large amounts will likely be selected by the auditors, and it is important to have all the relevant information ready. I hope that you have enjoyed this overview of adjusting entries.